we start then? Okay, great. Thank you very much. Hello, everyone. Thank you very much for joining us this afternoon to the session on carbon taxes, the nexus between fiscal and climate policy. I'm Asiel Goasem from the OECD, the head of the Tax and Environment Unit, and I am very honored to be sitting here with a panel of experts, some of whom have decades of expertise in this area. So the hope for this panel is that we will explore this special policy instrument that really sits at the intersection of fiscal policy and climate policies. And we'll try to delve into the successes, challenges, and lessons learned from countries that have adopted such taxes to, at the same time, reduce greenhouse gas emissions and also as a fiscal tool. We'll also discuss differences in implementing this policy instrument through design choices, the drivers that were influencing these policy choices, and how broader fiscal policy can influence price incentives. And so on the stage here sitting with me are several experts. Firstly, Jacob Vastrup, Director of Climate Energy at the Ministry of Taxation of Denmark. Charlene Hamraj, Director of Environment and Fuel Taxes at the National Treasury in South Africa. Ignacio Caceres, who is the Green Tax and Offsetting Schemes Specialist at the Ministry of Environment for Chile. Carlos Munoz Pina, who is currently the Director of Research, Data and Impact at the World Resources Institute, but who was previously General Director of Revenue for Mexico's Ministry of Finance, responsible for the implementation of carbon tax and fossil fuel subsidy phase-out. I will also like to thank Joe Pryor from the World Bank for helping organize this event. So the way this is going to go is that we'll have a couple of rounds of questions to the panelists, and then we'll open the floor to you for questions. So I think I'm going to have a question to all of you, the same question to kick off the session. And because we know that there are many ways that carbon taxes are implemented with different characteristics depending on country context and circumstances. And as we are here to learn more about these ways or the choices and in instrument design, it would be good to hear a bit about the key design aspects that were chosen for your respective carbon taxes. It would be also interesting to hear from you how the government interacted with stakeholders during the design and implementation phases of the instrument, as well as highlighting maybe some of the drivers and objectives behind the instrument, such as climate targets, fiscal reforms, new additional revenue sources, and of course understanding that all of this changes over time. So I turn to you, perhaps Jacob first.
Well, first of all, thank you for the opportunity to be on the panel. And you throw up some big questions and a lot of questions, so I'll see if I can be sort of very, very brief about it. In terms of the tax landscape, I think 2 years back in Denmark, you had an agreement on hiking CO2 taxes for industry, etc. So if I'm to sum up what came out of that, essentially it's essentially that for the ETS sector, the emissions covered by European trading scheme, you have a national tax on top of that, 50 euros per ton. And for all the non-ETS emissions, you have a tax of 100 euros per ton. There's some little bits I've left out, but that's the broad gist of it. And then moving on this spring, just early summer actually, there was an agreement to include agriculture into carbon taxing, which basically means that or rather once the tax will be implemented, we'll be at a space where basically all major sources of CO2 emissions and also CO2 equivalent emissions will be taxed subject to carbon taxes. not counting LULUCF, but other than that, pretty much. So yeah, I think at least sort of politically in Denmark, there are some people who think that's a big deal. You asked about the objective, and I think carbon taxes, as you hinted, can take more than one purpose, but essentially it's environmental regulation. It's climate driven. That's the brief answer. Well, mindful of time, just 3 things on process, I think. And here I'm thinking in terms of the industry hike, basically. I think 3 brief comments there. One is that we have a national target of 50% reduction in carbon emissions compared to 1990, which is enshrined in legislation. And that's sort of the driver or political backdrop to all of this. Then you had an expert group with a couple of well-known economists sort of coming with recommendations, including the chairman being a former chair of the Economic Council. So coming out with recommendations. And then I think an important aspect is also that as economists, we tend to say that you should have a uniform carbon tax. That's it. You have the perfect solution. Here, there's revenue cycling in there. So over the first couple of years, you have some funds set aside to help companies make the transition. I think that's an important sort of part of the process of understanding the whole process and the outcome. So I'll leave it at that.
Great.
That's a quick and lean.
Thank you. Thank you, Jacob. And Charlene, how is it going in South Africa?
Thanks very much, and thanks for the invitation to share South Africa's experience. So just in terms of our process on the carbon tax, and I think some of you will know, it took almost a decade to implement the carbon tax. It was a process that started on the backdrop of an environmental fiscal reform initiative that South Africa took in the early 2000s. And in terms of that process, it recognized the role for environmental taxes. And I think similar to Denmark, it was very clear around the policy principles in terms of polluter pays and the need to internalize these externalities. So the main objective of the carbon tax in South Africa is to make sure that the negative externalities are internalized, and the approach that we took was rather than implement a tax at the rate that fully internalizes the costs, which can go up to like $1,000 per ton, which is not entirely affordable for developing countries, was to start off at a lower rate initially, starting off at around $10 per ton, and gradually adjusting that tax over time in order to strengthen the price signals. And this approach was taken to ensure the political acceptance of the tax. As we were saying earlier, the 2 things that is certain is tax and death. Their meetings is the other one, but we won't get into that. Industry will always push back against any tax or instrument that affects their profits. And that was very clear in our process. So there was an extensive consultation process on the policy design. Some of the key issues that came up in terms of the discussion around the policy design was one was around the rate and what we started off at. And the other 2 big issues were related to the impacts on competitiveness of businesses, especially on the energy side, as well as the impact on low-income households. And in terms of the design of the tax, we had to take into account that we had existing taxes on electricity, for example, and we also had government support for a renewable energy independent power producer program. So those were viewed as sort of double, triple taxation in addition to the carbon tax. So we conceded on that, and for the first phase of the tax, we allowed for electricity generators to offset the costs associated with the electricity levy and the renewable energy program against the carbon tax. And this was a game changer because that was the sweetener on the side of business that helped to get the tax through to implementation. But what we were very clear on is that this will be done in a phased approach, and we expect that commitment around the revenue recycling measures to come to an end in December 2025. So we are heading into a period that's going to be of significant lobbying and consultation on the design of the tax. So that was a big area. The second area in terms of the design of the tax that I think is relevant in terms of this conference is that our industry had actually proposed a carbon offset mechanism as part of the design. The view was that we should provide flexibility to companies to help them transition, and some form of carbon finance that they're investing could be deducted against the carbon tax there. So we listened, as we do, to all stakeholders, and we implemented that mechanism, which is currently in place. And then just perhaps to say lastly, because this process with South Africa started towards the end of the 2000s and the tax was only implemented in June 2019, we then were quite bold, and in 2022 we announced the pathway for the increase of the taxes up to 2030. And this was to provide policy and investor certainty to guide those investment decisions that were needed. And this also built on our commitments for emissions to peak in 2025 and to decline from then up to 2030. So it was bold commitments in terms of our greenhouse gas emissions. So it was a combination of extensive consultations with industry, concessions that were made to encourage and enhance the political acceptance of the tax, and then also to make sure that over time we will definitely look at ways of strengthening the price signal to influence behavior change. Thanks.
Thanks, Charlene. Thank you. Already between Jacob and Charlene, we see that there were different considerations and country constraints and circumstances that drove a bit the design. So now we want to learn a bit from Chile. Ignacio?
Thank you, Asia. Chile's case follows one of our fiscal rules, which is that in order to pass a law that is going to commit spending for something, you need to also have a way of funding that law, right? So in 2014, the government that at that point was new in office, they wanted to pass an education reform and a social security reform, so they needed funding, and they made a broad tax law, right? And that tax reform had many different measures, and one of those was the carbon tax, which has a low rate. It's only at $5 per ton. And so the design of the carbon tax originally was mainly for revenue. It was a way to fund public measures for education. Even though from an environmental perspective, we would like the revenue of that tax to go down, right? Eventually, that no one pays it. But then in 2020, a more enterprise-friendly government decided to give them more flexibility, right? The same case as South Africa. So in the tax reform that was passed in 2020, they gave the opportunity to taxpayers to reduce their tax load by presenting emission reduction certificates, so an offsetting system. In that case, since fiscal revenue cannot be earmarked, and so the recycling of the carbon tax to pay for climate action or for environmental remediation was not possible, the offsetting system allows for the possibility of that money, or the money that would go to the tax, to be directed or redirected to environmental action. In that sense, the focus sort of changed towards a more environmental-centered topic. And something that is actually going on right now, so I don't know how it's going to end, but at the moment, the government is looking for some money to fund a subsidy to electrical bills. Because that's a big issue right now. They had frozen the bills, and now that measure ended, so they have to look for new sources of revenue, and they are actually planning to raise the tax, which is a good measure for the environment. But that raise in the tax it's not going to be able to be offsetted, right? So it's, again, we're going back to taking the tax as a measure to raise revenue, even though a big part of taxpayers, which are the energy sector, right, thermal plants, have plans to close down by 2030, 2050. So in this case, we're going to see it go down eventually, right? So it's very interesting how these objectives have been changing through the years, and depending, of course, on the needs of the country at the moment. Yes, I think I'll leave it at that.
Yeah, no, I think it's a nice remark that that it is not a static picture, that this is adapting and adjusting accordingly. So turning to Carlos, can you discuss Mexico's
Yes, our story is very similar to Chile. It was linked to spending. And at that time, 2014, Mexico was the country in the OECD with the lowest tax to GDP ratio. We were taxing the lowest and in effective terms. So when the time came to put up forward a set of bills, there were two alternatives. One of them was taxing food and medicine, which were not taxed, and on the other hand were a set of green taxes linked to energy. And then we chose to have perhaps smaller revenues, but go for fossil fuels. It was part of a measure in which the finance ministry allied with the environmental ministry and with academia were part of design. And part of the academia was the Nobel Prize Foundation by Mario Molina, the person who understood the hole in the ozone layer and therefore had a lot of political capital behind to put it there. One of the things to understand about the Mexico's design of the system is that we believe that we have explicit carbon taxes, like the label carbon tax, but also we have implicit carbon taxes. Whatever way you tax gasoline, diesel, any other fossil fuel is part of a carbon tax, even if it doesn't have that label. And that's part of our understanding. Now, when it came in, the original proposal was tax proportional to the carbon content, all fossil fuels upstream, corresponding. So if it had more carbon content per liter per ton, then it was proportional. And we looked at our main trading partners to see what prices were there in their carbon markets. And for us, California was a very important reference. The EU was another one. And at the time we saw it was around $5 per ton of CO2 traded, and that's the way it was presented to Congress. Obviously, once the political debate takes over, the prices are pressured down, so the negotiations ended with very intense rounds of lobbying, etc., with civil society being very active, with the regions also, with their senators and Congress people. It went down to $3.50, which is the way it's still now. But most importantly, there was a distortion. It was not proportional to carbon taxes. Industrial fuels were let off the hook a bit. They were down to $2 if it is coal, at $1.50. Some of the industrial ones, like fuel oil, was taxed also at $3.50. But natural gas was completely exempt. And the argument was that as part of the transition, we were going to be moving towards the, let's say, criteria pollutant, the local pollutant, industrial fuel that had less impact on the locality. So that's why natural gas was seen working on what economists would call cross-price elasticities. It's not only increasing price for all, but increasing it more for one and the other to switch towards natural gas. Offsets, because the finance ministry was very keen on this being an important source of revenue to fund our low tax base and do not tax other things which have positive externalities. We want food and medicines to be taxed lower than fossil fuels, which have negative externalities. Said offsets, we will curb the possibility of having offsets. So I might go into the rules that make this a very difficult thing to do. They really need to be very valuable offsets to go in. Otherwise, it is not. It has proved resilient. I would end with this. There have been changes of administration towards the left and towards the petro-state, more leaning governments, and still the carbon tax is there because it has proved its value as a revenue source and as an important economic signal to begin to decarbonize the economy.
I think that's an interesting point. The resilience of it could be perhaps linked to this fiscal contribution that it has. So that's one reason for having this instrument, certainly. So let's go now a bit deeper into the policy design choices that you have discussed a little bit. And so I'm interested to hear from each of the panelists on the process and considerations to specific design choices, including how they perhaps used modeling and assessment exercises to make some of these choices. So moving to Charlene and Carlos first, how did the government decide on sectors and activities to cover emissions and also the point of regulation, so whether to apply it upstream on fuel use or via point source coverage, so directly on emissions? So Charlene?
Yeah, so the simple way is, when we were looking at environmental taxes at the time the project started, there were existing taxes like fuel taxes that were already in place. And there's, various ways in which you can classify these taxes. But the issue was these taxes were inexistent. They played some role in terms of influencing behavior and indirectly pricing in the externalities. So we referred to them, Asia, as you would know, as environmentally related taxes there. And this used the OECD classification around taxes and to allow for comparison across jurisdictions. And that is where we started in sort of the early 2000s there. By the time we got to the carbon tax, you're dealing with the global externality. Countries have different share of the responsibilities towards the global commitments. And we had to go back and look at, what are the main sources of our emissions, which is very clear. What are the activities responsible for these emissions? What are the key greenhouse gases that are covered? What's the potential for mitigation across the different sectors? And that information actually was contained in our greenhouse gas inventory that is developed by the Department of Forestry, Fisheries and the Environment. So we worked very, very closely on our process around the carbon tax with them. And we were able to identify the main sources, which is essentially the energy sector that accounts for around 80% of our emissions. And for obvious reasons, I think similar to Mexico in a way, it's because we are fossil based. I have my colleagues here in the audience actually making sure that I say the right things today as well. So we took into account the greenhouse gas inventory, which very clearly set out the 3 categories of emissions that should be covered. So we covered the fuel combustion emissions, mainly from electricity, but also from the manufacturing industries. And we also applied in addition to the fuel levy, a carbon fuel levy that's based on carbon content to cover the transport sector emissions. We then covered industrial processes as well, and this was from 2019. So all the emissions from cement, the iron and steel sector, glass, chemicals are also within the scope of the tax. And we also covered certain fugitive emissions, which is emissions, for example, like coal mine methane from mining activities. as well. And our coal and gas to liquid fuel sector is covered within that. The view was that we needed to have comprehensive coverage because this is an economy-wide instrument to get the price signals in, but at the same time to design the taxes in a way that we recognize the different ways in which they can respond and the technologies available there. So those are the activities that are covered. The emissions are also quite broad. We cover carbon dioxide, methane, fluorocarbons, and all the other greenhouse gases as well. And again, based on what we report in terms of the inventory and the international guidelines developed by the I4C for emission factors. And perhaps the last point on this is that we took into account the science, and the science meaning that we need to get taxpayers to declare the actual emissions that they have. And we based a lot of this on the approaches outlined in the I4C guidelines, where we have the Tier 1 I4C emission factors, that's the global factors. We have the Tier 2 option, where we develop country-specific emission factors, which we have recently done for some liquid fuels. And then the third category, where you have company-specific emission factors, that's a combination of emission factors and direct measurements there. So we cater for this within the design of the tax, and the main objective is to make sure that you have accurate emissions reported, and because we don't want to overestimate the emissions. This was not viewed as a revenue instrument at the time we put it forward. So those were some of the considerations in the design of the tax. We took into account the international examples. I think Mexico had a carbon tax way before South Africa in place. We considered the issue of natural gas exemption as well in the design, but we opted for a broader base tax covering all activities in sectors and selective exemptions to take into account things like trade exposure, reduced carbon intensity of activities, etc. So I'll stop there.
Excellent, brilliant. Carlos?
And for us, we were also watching Chile and South Africa and the way they were deciding. And we approached it at the same way we approach a soccer field. We were playing football. And the idea was the finance ministry, on the one hand, was going to move forward the carbon tax, let's say on the right side of the field. And what we wanted is to have a broader coverage and to go to all fuels at the same time. Remember, the initiative was covering all. So the idea was there to go upstream. The moment the gasoline came out of the refinery or crossed the border or in any of the ports, then that's the way we taxed. And the implementers, the people managing the tax system said, we already know how to tax them for VAT, for other things. And the best way to get them is at the beginning. So in our entire fiscal system was already ready, set to go forward, to have to lose no time in implementation, but just using the same upstream approach to taxation. On the left field, the Ministry of the Environment, in charge of designing the carbon market, said, oh no, we want to go like Chile towards the emissions, because that's what we do. The regulators and the enforcement agencies goes with and takes indirect measures of the local pollutants. So the carbon market was designed to be downstream at the point of contact using the same structure. So you see, it was for ease of implementation. And having the double strategy, it was very resilient politically, because the moment they told, oh, you're not measuring downstream, said the Ministry of the Environment will do that for the carbon market, or you're not going upstream, oh, the Ministry of Finance will do that. So we covered both fields, and eventually that worked out very well. The interaction between the carbon tax and the carbon market is a story for later.
Indeed, but thanks a lot for explaining that. I mean, I think it's, like you said, it's important that we have this comprehensive coverage that eventually, the price increase could come at a later point. But now pivoting a little bit to Chile, which tends to be perhaps an innovator, pioneer, especially for a middle-income country. I think there are a lot of lessons to be learned. And so over time, I mean, Chile's carbon tax evolved, and now it sets an emission threshold so that only large emission sources are covered. This was not always the case, I think. But so how was this threshold selected, and what were the trade-offs with this approach?
Okay, yes. So indeed, it was not always like that. The carbon tax, when it was originally implemented, it only affected sources that had boilers or turbines with a certain thermal capacity, which left out all of the emissions from processes, right? It was based on technology. And by 2020, it was changed, and we established a threshold of 25,000 tons per year. So the objective of that was to actually affect the sources that were indeed being big polluters, because some companies or some establishments had big boilers, but they weren't using them all year round, or maybe a boiler was a bit smaller, but if you have an intensive use, you could be emitting much more, right? And since we are taxing emissions, we wanted to set a threshold that was coherent with that. The thing about setting the threshold is that in order to tax this, you need to, in fact, measure the emissions, right? And regularly, most sources in Chile have to declare their own emissions based on fuel consumption, or depending on the size, different technologies. But if you are closer to paying the tax, you have to make a different sort of declaration that is a more rigorous one. So setting the threshold means that you are giving these companies big costs, because they have to start using better technologies, better equipment, and there's a possibility that they're going to be sort of audited by the governments to see if their declarations are correct. So setting it had to do something with trying to have a broad coverage of emissions that are going to be taxed. We wanted to tax so all of the energy sector that is included, and some of the very big industrial sector, mostly well, steel, cement, because of the change in the definition, and some food processing that is very big. But also, you don't want to cover too many establishments so as to make them incurring big costs, but only get a small revenue, right? As I was telling you, so we have this 25,000 tons threshold for paying the tax, but if you are emitting over half of that, so 12,500 tons, you have to report. And at the moment, that is the threshold that we are discussing, because we get like 300 establishments, but out of those, only 100 pay the tax. And there aren't many that are 24 or 23,000 that you would say, oh, maybe next year they're going to pay. So having such a low threshold for reporting and so different from the one for paying is making these establishments report but not really go into the tax later. So I think at the moment, one of the challenges and one of the discussions that is probably going to be modified sooner is about the reporting threshold and trying to bring it closer so as to not have that sort of inefficient reporting efforts.
Yeah, no, that's very interesting to, what are the strategies to ensure that the incentives are there for reporting and reporting the right number. So that's very important considerations when deciding a carbon tax that is directly applied to emissions. Very, very edifying indeed. And now turning to an interesting development of late in Denmark. it's interesting that you have a carbon tax that in conjunction with an ETS, and then you're going even further and extending the carbon tax to agriculture, which is quite controversial and I guess courageous to be among the forerunners in this area. So so could you tell us a bit about how the process evolved? How did you engage with stakeholders, and what have been the main challenges so far and the key elements that garnered the requisite support to implement such an instrument?
Right. I think being a civil servant, I wouldn't call it controversial, perhaps tricky or something like that. But
Fair enough.
yeah, I think in terms of the process, probably a couple of things. As I sort of hinted before, before embarking on agriculture, more or less had a situation where all other major sources were covered by taxation and at a sort of reasonably substantial level. So going into that was definitely sort of part of it. I mentioned we had an expert group. Actually, their work was also sort of two-phased, where first they considered with the industry, which was then implemented, and then they went on and considered agriculture and came up with some specific recommendations and proposals in terms of how to tax it. In terms of the process, that was slightly different for agriculture in the sense that we had after the expert group came out, we had what we call a tripartite process, which is what we have also from the labor market. In the labor market, you have the employers, the employees, and the government sitting together and coming up with what you could call joint solutions. Here was on one side, you had the main farmers organization. On the other hand, you had also one of the main environmental organizations together with government. And, well, maybe you could call that a little bit of a tricky process. I won't. But at the end of that process actually came out an agreement that we should include agriculture and with some specific rates and so forth. And then I think also one thing to highlight there is in terms of the tax design, I think the clear political objective was that, I mean, we want essentially technical reductions, meaning a more climate-friendly way of producing rather than closing down production. And so in terms of the tax design, which was one of the things that came out of the expert group, was that the tax design includes some basic deductions, which gives a high incentive for using the technical solutions, but reduces the immediate impacts in terms of actual payment. I probably missed out part of the question.
No, I think it's just maybe you could inform us a little bit or discuss a little bit what were the main challenges and the key elements for getting the support you need.
Yeah, I mean, agriculture is sort of fairly carbon intensive if you look at terms of output compared to the emissions linked to that production. So that was definitely a sort of big concern. So it's this, I think, also alluded to with South African experience and others. It's this sort of what you call the competitiveness angle, and sort of as an economist, the trick, so to speak, was coming up with this tax design where you were able to have on the margin a fairly high tax rate, but as an average tax rate, a lower tax rate. I won't try to explain the details, but I'm happy to fill on more of that. And then I think the second part of it is obviously also for agriculture, you have the sort of the revenue recycling, and I would probably call it revenue recycling plus. I mean, there's some funds set aside for helping transition, helping farmers get into climate-friendly technologies, and the balance with revenue is probably that the support is bigger than the revenue.
Okay. Great. Yeah, no, I mean, I think there's a lot to learn for everyone for this, because I think it's still uncharted territory. I mean, I know for sure that in our work we know that agriculture emissions are very much uncovered by pricing instruments. So we'll keep a close eye on that. And so this round of questions is a bit of a novelty. So we are going to give an opportunity for the panelists to ask each other questions. So let's be nice-ish. And in that spirit, I turn to Carlos. Who will ask a question to Jacob.
Jacob, yes, it's a follow-up. So you being an economist, and when the tax is designed, you must be expecting some reduction. So what is the reduction in what type of agrochemicals or what type of economic level of output? What do you expect from the tax being proposed to have an effect on agriculture? And I'm meaning how much of a reduction will you get for your proposal?
Ooh, you were asking specific numbers here. This was
An
before
approximation,
summer.
you can round them to the 10, because it's a political investment. You have to say, believe this will work to reduce the emissions.
Yeah.
And how much?
There was some obviously some sort of economic modeling going on before that, and if I remember correctly, they said that by 2030 the tax it's about 1.5 million tons or so. So with that, we're basically on track to meet the 70% reduction target by 2030.
Okay.
That comprises of a sort of a combination of technical reductions, i.e. more climate-friendly production technologies. So it involves things like more climate-friendly stables. It involves stuff like food additives for less methane from digestants and also from getting the manure quickly into the...
So the goal of 70% is for the overall economy.
That's for the overall economy, yes.
And you said 1 million tons less from agriculture.
Oh, yeah.
So how much, that million represents 10%, 20?
I think it, I'm so used to doing the percentages. If I recall correctly, the overall emissions from agriculture is like 10 million tons. So it's
Okay. So 10%,
yeah.
right, which is very valuable as a proposal. I'll leave it there. Thank you.
Okay, good. And now Jacob, it's your opportunity.
Yeah. I think it came out of, as I mentioned, we have carbon taxes on top of the ETS, which brings me to this thing with multiple pricing instruments. And so I was thinking for Ignacio also, thinking about multiple pricing instruments, including carbon credits, just your sort of views on how they interact and the trade-offs.
Yes. So at the moment we have, the carbon tax on emissions, right? The carbon tax itself. That's I'd say the biggest instrument or economic instrument to curb emissions. But that also goes hand in hand with an offsetting system, right? So the use of carbon credits, both certified domestically and also coming from international standards, as well as the project is based in Chile, can be used to offset those emissions. And in that sense, that allows us sort of to make a financial flow of money to fund climate action. But also we have been thinking about different instruments. As an example, the Ministry of Energy is working with the PMI project with the World Bank, so as to establish sort of an ETS pilot for the energy sector, right? Energy is one, they pay about 90% of the carbon tax. So that would mean some sort of intersection between instruments, and that would have to be designed so as to impose too much of a load on those taxpayers, and also so as to send the right price signal, right? Because we're trying sort of to adjust the prices, the price of emitting. The framework law on climate change, which was passed about a couple of years ago, also has another instrument, which are greenhouse gases standards. So you set sort of a cap of how much you can emit, and if you go above that amount, you would need to put in some credits. It's not properly a cap and trade system, but it works in a similar way, right? So we are working at the moment on designing those, and that has to be, or we want it to be complementary to the emissions that are taxed by the carbon tax. For example, methane emissions from landfills, which at the moment don't have to pay taxes, or HFC, or some gases that are not being at the moment taxed, or some industries that maybe have lower emissions, right, lower than 25,000, and would not have to pay. In the case that those instruments would in fact intersect, we would have to evaluate maybe giving them an exception from the carbon system, from the carbon tax system, or perhaps a way of not being too hard on themselves, or sort of not to damage the economic functioning of those industries.
Great. Thanks, Ignacio. And now, Ignacio, your turn to ask a question.
Yes. So as I was saying, we're at the moment implementing our offset system. It has only been working for 1 year. So it's pretty much a new thing, and we're trying to get recommendations and to see, try to see how it's gonna be in the future. So I'd like to ask Charlene about South Africa's experience with the offset system, and in particular, if this has had any impact in promoting the financing of climate action projects, and also if it's had any impact on the emitters, right, and on the companies that are taxed by at the moment, because the offsetting system makes it more flexible, maybe cheaper for them to pay. So maybe it's been an incentive to go back to worst practice and emitting more.
Difficult question, Ignacio. So, look, we have the offsets in place. The eligible projects are projects developed under international standards currently. The CDM, the gold standard, and the Vera. And the main reason for that was to maintain the environment integrity of the carbon tax system and the offset system within it. Historically, under the CDM, we did not see a big take-up of the CDM in South Africa compared to some of the Asian countries, South America, there. And the main reason for that was, according to our stakeholders, is due to the high costs involved in getting these projects approved under the international standards, and then to go through an entire process around getting those credits verified and authenticated and approved of, so they can be used within the relevant, at the time, the ETS market. So I think we had around 50 CDM projects. The last time I could remember that we're registered, and now we're in the Article 6 world, which is a different story. But for the carbon tax, we had about, so the offset projects developed in South Africa are recognized. We allow for certain renewable energy projects developed before the introduction of the tax to be eligible, that were approved in the system before. So we currently have around 38 projects registered on our carbon offset administration system, and this is managed by our Department of Energy, because they were the DNA under the CDM. There's about almost 15 million offset offsets that were listed within this COAS at the time that the carbon tax came into effect from that time, and about 13.5 million that has been retired for purposes of the carbon tax there. So we're looking at a market value of around 90 million US dollars in terms of the value of that market. So we haven't seen a growth in terms of new projects, but what we have been pushed towards is developing a local standard that can be used by companies to get projects approved, developed, to also look at standards, the big issue around removals and agriculture and all of that, so to look at methodologies around it. And our Department of Energy developed a framework for evaluating potential local standards. It was done through the PMR project of the World Bank, and we're aiming to finalize that framework this year in order to try and get more local projects in the system. And then, as you say, to encourage that market to develop, because as much people push back on carbon pricing and carbon taxation, you would expect there to be a take-up in terms of offsets, but you're also not seeing that take off as well, and there are other reasons cited. So I think it's a question as well at a company level of the commitment around reducing emissions, the net zero strategy to 2050, and maybe there's a further nudge that is needed. Perhaps the CBAM is going to do that there. So I think there's still a lot of uncertainty at a company level on how much they should be looking at diversifying their businesses. And there are even, I think, conversations underway around especially fossil fuel-based economies and businesses, about whether the businesses should continue. So that's just the way the system is evolving as we are seeing it there. But the reality is, if you don't build in a carbon constraint at a company level, then you will be going out of business. And I think that's the issue there. So yeah, I think I've taken longer than I should have on that one. But it's a complicated issue.
Yeah, no, it's an emerging area. So thanks a lot, Charlene. And if you can ask the last question. I know we're running out of time, or we already ran out of time. So.
Yes. So Carlos, this is the difficult one that you put to us earlier there. So we all have experience with doing policy analysis and research before we implement carbon pricing measures and look at various models, etc. But you flagged with us the critical issue as we move forward around the ex-post analysis of the impacts of these instruments as we go forward. So maybe you could share with us some of your views around the approaches that are available to assess the impacts and how realistic they are in being able to assist us with effectively measuring, emission reductions, for example, as we move forward. And my hope is, Carlos, that it would be towards how this can inform, future design and changes to the policy instrument to strengthen the price signal. But I'll stop there.
Oh, yes. That's a difficult one, Charlene, as well. And I would say that to answer this, we didn't do it alone. We asked help from the OECD, we went to ICAP, and actually there's a paper in which we are, in 2022 paper, in which we attempt to measure the effect. It's in the Journal of Energy and Environmental Policy, EEP, 2022. And with Marisa Montesoca, my co-author from the Harty School of Government, and at the time at ICAP, and with Marisol Rivera from the Ministry of the Environment. And what our first question for that is, what do we do with, how do we build a counterfactual? What would have happened if we didn't have this one? And remember, I started by saying that we have explicit carbon taxes and implicit ones. And the implicit one was related to the G20 policy or agreement of phasing out fossil fuel subsidies. So for us, it includes both things. And remember, Mexico was giving out as fossil fuel subsidies 1.8% of its GDP in the late aughts, the 2008. So between 2008, we started with the phase out and completed it by 2014. We capped it with the carbon tax, and then we went on to increase the tax for gasoline and diesel to get the excise tax up again. And that represented 1.4% of GDP. So we increased the implicit taxes, most of it. So our estimates, or the estimates in the 22 paper, is that thanks to both the phase-out and the carbon tax, we obtained a 20% reduction of emissions if the policy had remained the same, if we still have had the subsidies as they were. If we had not removed the subsidies and not put the carbon tax, positive carbon taxes, we would have been currently now emitting 20% more. And the argument is that Mexico has a goal of being 22% below the expected baseline by 2030. Now it's 35 below the baseline. And the baseline is basically built as growing 48%. So we would have been 48% emitting more. The goal is 35% less than that. And I would say implicit and explicit carbon taxes account for 20 of those percentage points. And the suggestion or the recommendation is try to build the realistic counterfactual. What would have been the price? And it's logical that having so much political pressure against not increasing the price of gasoline and diesel, the transport lobby, the citizens have a strong political voice against that. What we used is when the international prices went down, the international oil prices went down, then we can increase the implicit carbon price, and it is not noticeable as an increase in the price that you pay at the pump or that you pay at if you're an industry, at the industry gate. You don't see it, but the carbon price is there. That would be my strong recommendation. Try to build the counterfactuals and just measure this. The price elasticity of fossil fuels is between 0.5, it's inelastic but relevant, especially if you're putting high taxes, and with some help and support and these complementary policies that we're speaking, the price elasticity would be between 0.8 and 1. So it is with that kind of economic reaction that we need to work with.
Excellent. Good. I'm not sure if we have time for the audience questions. I think we are well over time, but I hope that there was enough of a rich discussion to satisfy your appetite for more. I certainly learned a lot, and I think it was evident that the picture is shifting. We're learning, I think, collectively. We need to be agile and flexible enough to adapt to changing circumstances, both domestically and internationally. So I thank the panel very much. I thank you for your patience with us and for staying with us. And with that, off to dinner. Is that what it is? All right, thank you.